Peloton Interactive Inc., the connected fitness platform, premium exercise bikes, treadmills, and rowing machines, paired with tens of thousands of live and on-demand classes.
PTON generated $2.5 billion in FY 2025 revenue at 51% gross margin, executing a turnaround that produced the first trailing 12-month period of positive net income.
The story begins in 2012. Peloton was founded in New York, commercializing connected indoor cycling with a touchscreen bike and live-streamed classes. The 2019 NASDAQ IPO raised $1.2 billion.
In 2023, Peloton signed a 5-year partnership with Lululemon, becoming the exclusive digital fitness content provider after Lululemon wound down its Mirror acquisition.
Peter Stern, Apple Fitness Plus co-founder, became CEO January 2025. He launched Peloton IQ AI coaching and the cross-training hardware refresh. A Spotify content deal added a new revenue stream in 2026.
Subscriptions generate 67% of revenue. All access memberships at $24 per month, app memberships at $12.99. Hardware contributes the remaining 33%.
Peloton's fiscal year ends June 30th, making the quarter reported today fiscal Q3 2026. The Spotify deal and Precor commercial expansion add high-margin revenue streams.
FY 2025 gross margin reached 51%, up from 45% in FY 2024. Hardware margin recovered to positive. Subscription mix grew. Operating losses shrank 93% to $36 million.
Q3 FY 2026, revenue $630 million beat estimates, net income $26 million. Adjusted EBITDA $126 million rose 41%. FY 2026 EBITDA guidance raised to $470 to $480 million.
Apple Fitness Plus is the most direct competitor, leveraging iPhone and Apple Watch integration. It has lower hardware attachment, but dramatically higher margin through the Apple One subscription bundle.
Nike Training Club and Lululemon compete on app subscriptions. iFit competes in hardware via Nordic Track. Peloton's content library, tens of thousands of instructor-led classes, is the primary moat.
Peloton's moat is instructor celebrity and community. No other platform has built the same parasocial fitness relationship at scale. 2.7 million paying subscribers choose Peloton for instructors, not hardware.
The U.S. is the primary market, 2.7 million paid subscribers through onepeloton.com, Amazon, and retail showrooms. The Precor commercial series extends into hotels, gyms, and corporate fitness centers.
Peloton operates in the UK, Germany, Canada, and Australia. International is a mid-single-digit revenue share. The Spotify deal distributes classes globally as a new content monetization channel.
Peter Stern became CEO on January 1, 2025, bringing subscription services and hardware expertise from Apple, where he co-founded Apple Fitness Plus and led VP of Services overseeing iCloud, Apple TV Plus, and Apple One.
Stern holds a Harvard BA and a Yale Law JD, rare for a product-led CEO. Before Apple, he was EVP at Time Warner Cable, and before Peloton, he led Ford's Connected Services as President of Integrated Services.
Peloton, the connected fitness platform, $2.5 billion in FY 2025 revenue with subscription leverage, the Lululemon partnership, and commercial expansion as the compounding margin drivers.
Fiscal Q3 2026, first trailing 12-month positive net income in company history. Revenue $630 beat estimates. EBITDA $126 million rose 41%. Full-year guidance raised.
Peloton just posted its first real operating profit in years, and the market has a right to be skeptical. This is a company that went from pandemic darling to near bankruptcy in 3 years. But something shifted in Q1 2026. Subscriptions are holding, margins are expanding, and a new CEO is quietly rewriting the playbook. Today we find out if this turnaround is real or just another head fake.
For anyone who needs a refresher, Peloton Interactive started as a hardware company. Bikes, treadmills, rowing machines. The pitch was simple: a gym in your living room with a live instructor on the screen. It worked brilliantly during COVID. Membership exploded. The stock hit $95 in January 2021. Then gyms reopened and the whole story unraveled.
What's left today is a leaner, restructured company with about 2.9 million connected fitness subscribers and a deliberate shift away from hardware dependency. The new thesis is fitness as a service, recurring subscription revenue at 50% plus gross margins. That's what CEO Peter Stern inherited when he walked in the door in January 2025, and that's the bet he's been building toward for the past 5 quarters.
Let's get into the numbers. Q1 2026, which is Peloton's fiscal third quarter ending March 31st, came in at $631 million in revenue. That's up 1.1% year over year from $624 million in Q1 2025. Not explosive growth, but critically, it is growth. For a company that spent the last 2 years in freefall, flat to up is meaningful.
The street was expecting around $616 million. Peloton beat by $15 million, a 2.5% revenue beat. And this wasn't a quality of earnings issue. Gross profit came in at $327.2 million, giving a gross margin of 51.8%. That's consistent. That's the subscription engine doing what it's supposed to do.
Operating income flipped positive in a meaningful way. $52.5 million, an operating margin of 8.3%. Compare that to the same quarter 1 year ago, negative $32.4 million, negative 5.2% operating margin. That is a 40.7 percentage point swing in operating margin in 12 months. That's not a rounding error. That's restructuring working.
Net income, $24.9 million. Earnings per share came in at 6 cents. The consensus estimate was negative 8 cents. Peloton beat the EPS estimate by 14 cents, which is a massive upside surprise for a company trading at $5-something. Cash flow was even better. Operating cash flow hit $152.7 million. Free cash flow was $150.5 million, both quarterly records under the new regime.
The balance sheet picture is complicated. Peloton has $1.04 billion in cash, enough runway to execute, but it also carries $1.03 billion in debt. Total equity is negative $414 million, which means liabilities exceed assets. The debt-to-equity ratio is literally negative 2.5 because there is no positive equity. That is not a clean balance sheet. It is a company operating from a position of financial constraint, and investors need to understand that context.
The 5-quarter revenue trend tells the real story. 624, 607, 551, 657, 631. There's a mid-period dip. The September 2025 quarter was weak, but the company has stabilized in the $600 million range. The December quarter was a holiday bump. March is the cleaner subscription baseline, and that baseline is holding.
Peter Stern comes from Apple. He ran Apple Services, which is one of the highest margin businesses in the world. His entire operating philosophy is about monetizing an installed base, not chasing new hardware unit sales. That is exactly the mental model Peloton needed. He's also a cost disciplinarian. Headcount is down to under 3,000 employees. That's less than half what it was at peak. The savings are showing up in operating leverage.
So what does forward guidance look like? Peloton has been cautious with how explicitly it guides, but the structural direction is clear. Management is targeting continued subscription revenue growth, margin expansion on the hardware side, and international rollout of the app-only tier, which requires no bike purchase and opens the total addressable market dramatically.
The app-only subscription is a pivotal product. At $12.99 a month, it lets anyone use Peloton's instructor-led classes on any device without buying a Peloton machine. That removes the biggest barrier to adoption, the $1,500 to $3,000 hardware cost. If Peloton can scale app subscribers, it diversifies away from hardware demand risk and grows the revenue base without any inventory exposure.
On hardware, management isn't pretending demand is going to explode. The strategy is stabilization and margin improvement, not volume growth. If they can sell fewer bikes at higher margins while growing subscription attach rates, that's a better business than selling lots of bikes at thin margins. The Q1 gross margin of 52% suggests this mix shift is working. Connected fitness subscription gross margins are believed to run above 70% internally.
International is the medium-term lever. The U.S. connected fitness market is largely penetrated at the premium price point, but Peloton has brand recognition and instructor talent that translates globally. Canada, the UK, Germany, and Australia are the primary markets today. Management has signaled expansion into additional European markets and potentially Asia-Pacific over the next 2 years, with the app-only tier as the low-friction entry point.
The cash flow generation in Q1, $150 million in free cash flow, gives Peloton real optionality. That could fund debt repayment, it could fund marketing to grow app subscribers, or it could fund content partnerships. The capital allocation decisions ahead will reveal how confident management is in the organic growth story versus balance sheet repair.
The competitive landscape is genuinely tough. Nike and Lululemon both have fitness content ambitions. Lululemon acquired Mirror in 2020, fumbled it, and eventually exited, which is a cautionary tale, but also signals the market is difficult. The real competitive threat isn't traditional fitness brands, it's Apple. Apple Fitness Plus comes free with an Apple Watch, which already has over 100 million installed users globally. That is a $0 alternative for a Peloton app subscriber.
Peloton's counterargument is the quality and community of its content, the instructor relationships, the live leaderboard experience, the social layer that Apple hasn't replicated. Peloton has 30-plus world-class instructors who are legitimately famous. Robin Arzon, Cody Rigsby, these aren't just trainers, they're talent with personal audiences. That content moat is real, but it's also a recurring cost. Retaining that talent requires competitive compensation, which pressures the margin thesis if subscription growth slows.
The bull case for Peloton centers on 3 things. First, the subscription base of nearly 3 million connected fitness subscribers is sticky. Churn on these paid subscribers is historically low. Once someone has a Peloton in their home, they tend to keep the subscription. Second, operating leverage is real and accelerating. The $52 million in operating profit this quarter would have been unthinkable 18 months ago. Third, the app-only tier is optionality the market isn't fully pricing in.
If app-only subscribers grow to 2 million over 3 years at $12.99 per month, that's roughly $300 million in annualized high-margin revenue that doesn't exist today. Add that to the connected fitness subscriber base, and you have a company generating north of $500 million in recurring subscription revenue annually, at margins that could support a very different valuation conversation. The stock trades at roughly $2.3 billion market cap today. If the subscription model delivers, that looks cheap.
Now, the bear case, and Hudson and I agreed we are not softening this. Hardware demand is not cyclically depressed, it is structurally declining. The home fitness equipment boom was a COVID anomaly. People go back to gyms. Peloton's total connected fitness subscriber count has actually declined from its pandemic peak of over 3 million. They are fighting to hold 2.9 million while trying to grow the app tier. That's not a growth story. That's a substitution story.
The balance sheet is a real risk, not just a disclosure item. Negative equity of $414 million and $1.03 billion in debt means Peloton is operating without a safety net. If free cash flow deteriorates, a bad holiday quarter, a hardware recall, a major content crisis, the company's options narrow quickly. Refinancing debt at higher rates would crush the margin improvement story. And with a $2 billion market cap, equity issuance to fix the balance sheet would be deeply dilutive.
So where does this leave investors? Peloton is a high-conviction turnaround story at an early stage. Q1 2026 is the most encouraging quarter in the company's post-pandemic history. Revenue is stabilizing, operating margins are expanding, cash flow is strong, and the CEO has the right background for the pivot. The investment thesis is simple. Can a subscription business with 3 million sticky customers, improving margins, and $1 billion in cash sustain its turnaround long enough to fix the balance sheet?
The honest answer is probably, but not certainly. The margin expansion needs to continue for 2 to 3 more quarters before the balance sheet pressure becomes manageable. Subscriber count needs to grow, or at minimum hold, while the app-only tier adds net new revenue, and hardware can't become a cash drain. If those 3 things hold, Peloton in 2027 looks like a fundamentally different company. If any one of them slips, the debt load amplifies the problem. At $5.66 a share, this is a speculative position, not a core holding.
The broader market context matters here. Consumer discretionary is under pressure in a high-rate, high-debt environment. Peloton's target customer, the upper-middle-class household that spends $1,500 on a bike and $12 a month on classes, is being squeezed. Sentiment data on consumer spending in that segment has softened heading into the back half of 2026. That's a headwind Peloton can't control, and it's baked into the caution on the stock.
Peloton isn't the same company it was in 2021, and that might actually be a good thing. The disciplined, subscription-first version of Peloton is a more defensible business. Q1 2026 proves the model can generate cash. The question from here is whether it can generate enough, fast enough, to matter. We'll be watching subscriber count and operating margin every quarter. Thanks for riding with Charged Alpha. This content is for educational and informational purposes only. Nothing discussed here constitutes financial advice, a recommendation to buy or sell any security, or an offer to invest. Always do your own research and consult a qualified financial professional before making any investment decisions. Charged Alpha does not hold positions in the securities discussed unless explicitly stated. Past performance is not indicative of future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.